Hello and welcome back to another episode of Policy and Profits. I play an economist on TV. My name is E.J. Antoni. I am joined by the one, the only trader extraordinaire, Anthony Esposito. Anthony, how are you doing, sir?
Mr. Antoni, I'm fine. How are you today?
I am hanging in. It's been another crazy week. A lot of data dumps, tons of drama out of DC and even Mar-a-Lago. So tons of news, lots of stuff to get through. But all in all, it's hey, there's always money to be made in every situation, right? Bulls make money, bears make money, pigs get slaughtered. So the moral of the story is don't be greedy.
That's right. That's right. I'm living through that right now as we speak. Winning at life, as I say. We're trying to. So I follow you, obviously, on X religiously, and you are excellent at following debt deficits and kind of that rolling story of where we are. So I want to start by looking at the current U.S. debt chart that you put up on X this week. And I'm sorry that we're doing this ahead of the CPI, PPI. That'll be interesting to talk about next week. But for right now, total U.S. debt at what now? We're above $36 trillion. Where are we? And what does this look like to you? If this was a stock, this would be the investment of a lifetime.
Yeah, exactly. Yeah, stonks go up, as the kids say. Yeah, we're closing in on 36.2. We're adding about $1 trillion every 100 days or so. So we're definitely going to blow past the $2 trillion deficit marker for this coming fiscal year. I mean, look, this is frankly just turning out to be an absolute disaster. And unfortunately, we're at the point now, Anthony, where so much of the spending that we saw under the Biden administration, which it was a lot of one-time stuff, right? It was a spending bill that blew a ton of money on special project X, Y, or Z, or a special interest, or Green New Deal garbage, whatever the case may be, right? But at least a lot of that was one-time expenditure that didn't renew forever. Now, some of it did, and that's terrible, but a lot of it was just one-offs, and they just kept replacing those one-offs with one thing after another, which is why the spending continued to be so high for so long. Here's something that'll really blow your mind. If Biden had done absolutely nothing when he came into office, simply allowed the one-time emergency spending under COVID 2020 to expire, we'd actually have a balanced budget today. That just goes to show you how much excess spending we have had over the last several years. So where we're at today, though, the problem is that the debt has ballooned so much. And with today's relatively higher interest rates compared to where they were, 5-10 years ago, we're seeing the interest expense on the debt absolutely explode. So that's going to be about 1.4 trillion probably for this fiscal year. And so even if you allow a lot of that one-time spending to expire, which it looks like it will now that Trump's back, you still have the problem of that spending getting replaced by the higher interest on this debt, which, as you can see from this chart, has just exploded. I mean, numbers go up and to the right, as they say, and it's becoming a big problem. The Treasury Secretary is going to have a huge fight on his hands trying to get this debt refinanced at lower interest rates. There's going to be about $7 trillion of that Treasury debt coming due this coming calendar year, 2025. So again, he's got an absolute mess on his hands.
No, the rate issue is a problem. And, for a long time, I believed that the Fed would not raise rates simply because we wouldn't be able to service our national debt at higher rates. But the market took over and we kind of ended up in a spot where we needed to. And as inflation was spiking, raise rates. And that puts us at 1.1 trillion per year just in interest. Where is that on our list of expenses, national expenses? That has to be top 2 or 3 as far as what we're spending on a particular line item, right? We have, what's our overall budget? 6.5 trillion, 7 trillion?
Right. You're absolutely right. And what we've seen basically is that interest on, if we look at the monthly Treasury statements that we get, interest on the debt bounces back and forth between exactly what you just said, Anthony, the number 2 and the number 3 position. So it just depends, on the month. So the only 2 items that for an entire fiscal year or for an entire calendar year are larger than the interest on the debt would be the Department of Health and Human Services and the Social Security Administration. Every other line item at this point is smaller than interest, and that includes all military spending, so the defense budget. Now, one of the things that that sometimes people will get confused about when they look at those monthly Treasury statements is that you can find interest as net interest or as gross interest.
Okay.
Net interest is basically just a completely made up category. This is something we've talked about before. Treasury takes their total interest expense and then they subtract out a bunch of different sources of what are effectively interest revenue. One good example of that would be when people are behind on their taxes and interest is accruing on those back payments. The Treasury just says, oh, well, that's an interest incoming, an interest source of revenue, and we have an interest expense, so we'll just use those to cancel each other out, as if that means that interest on the debt has somehow magically gone down. So that's why we always want to look at what's called gross interest, which is the actual cost of servicing this debt.
So massive debt, massive deficits. I found a clip of Ronald Reagan, who went through inflation and the relationship between debt and deficits and inflation perfectly. And it kind of eliminates this conversation where everyone's so focused on the Fed, so focused on Fed funds rate. How does debt and deficits actually relate to and feed inflation? So I want to listen to that for a second because he's just fantastic.
The fact is, we'll never build a lasting economic recovery by going deeper into debt at a faster rate than we ever have before. It took this nation 166 years, until the middle of World War II, to finally accumulate a debt of $95 billion. It took this administration just the last 12 months to add $95 billion to the debt. And this administration has rung up almost 1/4 of the total national debt in just these short 19 months. Inflation is the cause of recession and unemployment, and we're not going to have real prosperity or recovery until we stop fighting the symptoms and start fighting the disease. There's only one cause for inflation: government spending more than government takes in.
I mean, game, set, match, as far as I'm concerned. You put just 100%. So well put. The first thing that shocks me and strikes me is we're talking about, in that case, a $95 billion. We hand that out to Zelensky on a weekly. It's like that doesn't even matter.
Exactly.
It's a rounding error at this point. But look, government spending, government debt, inflation, recession, poor employment, lack of growth. This is where we are. We're sitting in it right now, and it's at an extreme, as we can tell from the chart we had before. You had posted a chart, and we'll roll into the consumer, because I think this is really important. We went through Black Friday and Cyber Monday and all this stuff and the holidays and kind of finishing up the year. Where is the consumer based on consumer debt, revolving debt, interest rates, which, by the way, credit card interest rates are now at an all-time high. Mr. Powell, you're not helping too much. But then we look at this chart you had put up, where over 25% of the middle income earners in this country are living paycheck to paycheck. Mm-hmm. Could you run through this chart for me? Because I love the trend line and I love the detail in here. What are we looking at here, and what is this showing based on showing us about the consumer in the country?
So this is from a company called Primerica, and it's their household budget index, they call it. So what they do is they basically take inflation metrics like the CPI, but then they pull out all of the things that we would consider to be not necessities. So they don't want to look at, what does it cost to take a family on a vacation? They're looking at how much are the basic food items. So whether it's bread, whether it's beef, chicken, you're looking at just the basics. You're looking at housing costs. You're looking at, the cost for a daily commute, whether that's public transportation or gasoline and a car payment. Again, get rid of the luxuries, just look at the necessities. And sure enough, what they find is that if you are only counting necessities, inflation's been much worse than the headline numbers. And that means that people's wages adjusted for inflation are even lower than we previously estimated that they were. And so in this chart, it's got a real good uptrend line, very, very positive growth during the previous economic expansion before COVID. It basically collapses after 2020. It starts heading down in 2020 at the end, but it really plummets in 21 and then even into 22. It has since picked up, but the problem is we are way below that pre-pandemic trend. And although you can argue We are now slightly above the pre-pandemic level. So we're slightly above right now where we were in 2019. The problem is that we should be way above because you have many more people working. Those people are working more jobs. They're working longer hours. The total number of man hours have gone up to buy exactly what you could buy in 2019. And so what this index is basically saying is, all right, when you are above or below the 100% level, that's when families have any money left over at the end of the month after they purchase all of their necessities. So again, we are above that 100% mark, which is good. The problem is that to do that, we've had to, again, increase the number of people working. A lot of spouses, for example, when their spouse is working, the second spouse has to go back into work. We have people working more jobs, longer hours, et cetera. So again, this index just looks at necessities, and it just looks at middle-class households. So we're not looking at the very poor who are on welfare. We're not looking at the very wealthy who inflation for them is a rounding error, as you were saying about that $95 billion in debt. It is really, this index is really trying to zero in on what middle America is feeling today. And in a word, the answer there is pain.
Yeah, and no longer. Look, I'm honestly so tired and so glad that we don't have to hear the rhetoric anymore that it's everything's good. What you feel is not real. Your day to day is not real. Or wages are higher. Inflation is down. The price of oil is down. The price of gasoline is down. Groceries are down. These talking points are just far beyond like what I can stomach anymore. Everyone knows their day to day is a lot harder than what the administration and the media wants us to believe. And even to be honest, what the statistics seem to be showing when you dig into them and you look at them or you go through your day to day, you know that life is not, you go buy eggs, you go put gas in your car, you're trying to get through the holidays, whether it be Thanksgiving or Christmas or Hanukkah, and you need to buy the extra food, you need to entertain, it's brutal. It's brutal. So we had a second chart right to follow through with this that we had pulled. This came by, it was actually posted by the Kobayashi letter on X, and I guess it was Data Wrapper that created it. And it shows, again, people earning under $50,000 a year and what they're reporting as far as how they're managing, which I think is really interesting. And a couple of these things kind of popped out. So under $50,000 a year, slightly below the national average wage and income, but kind of middle America, middle class, as basically. 43% ate out less at restaurants. Okay, so you kind of tighten up a little bit. That's fine. Took no or fewer vacations, 36%. Okay. Now we start to get into things that are, to your point, the necessities. Like what are people, where's the real pain, right? If you don't go to Disney or you don't go to the Bahamas with the kids, like, okay, so be it. But you have 25% of middle America, well, not middle America, but middle class families in America borrowing money from friends or family that they have to pay back. You have 24% skipping meals completely, and 23%, this one kills me, sold belongings to raise money to pay for the expenses or the necessities that they need in order to keep their family and their life moving. Like, these are horrible statistics for the greatest nation in the world, the largest economy in the world, to be just shovel fed the fact that we're in good shape and everything's okay. Oh, and by the way, we haven't been in recession. There was no recession in 22. Don't just ignore those consecutive negative ticks in GDP and ignore inflation and ignore interest rates and ignore the defaults on debt. And these are the things that we look at and say there is a lot of pain out there. I don't know when it finally comes to a head and explodes, but I would say we have to be getting close. There's just too much pain out there and people are struggling too much to not have somewhat of a capitulation where we kind of reset, and then through President Trump and better policy, top-down policy, we'll regain our footing. But these are the things that are going to blow up as President Trump steps in for his second term on January 20th that really were all landmines put in place by the Biden administration and the current top-down policy.
100%, Anthony. I think you're absolutely spot on here. And when you have numbers this bad, to your point, and people are this frustrated, I think that's how you get results like we saw in November, where Trump wins literally every single swing state. People like Trump, and this is not a knock on President Trump, but I think people like him are a symptom, not a cause. You don't get a former Atlantic City casino owner into the White House unless people are really, really mad with the current situation. Again, it's not a knock on President Trump, whom I adore. I think he did a great job his first term. I think he's going to do an even better job this second time around. But again, you don't get people like him, people who are so unlike the typical politician, unless things have gotten really, really bad. I mean, looking at some of these numbers, 14% of people had to dip into their retirement savings. That's actually something we talked about back in October with that one study I wrote on how bad people's retirement accounts have done, particularly on the fixed income side. And you had all of these, you have all these people, a record high number actually, who are having to do hardship withdrawals from their IRAs. And it's not even necessarily that they're doing it for themselves; they're doing it to try to help their kids. And sure enough, we look at this chart again. I mean, it's astonishing the percentage of people who are, there's people who moved in with parents, people who moved in with kids, people who moved in with other family members. I mean, you add that up, and what's that? That's more than a quarter of Americans right there. Yeah. And it's astonishing, again, how many people have been doing hardship withdrawals on their retirement savings in order to try to help not just themselves, but family members. Again, really, really speaks to just how strapped the consumer is right now.
Yeah. And it honestly, I feel it. Like I really feel for the way people need to move through life and manage based on such poor leadership. I truly do. And I think President Trump coming in this is to your point, this is why he swept the country. And I don't even believe there are certain states that he got really close, like a New Jersey or California or New York, where the votes were much, much different than in the past. Never mind as we break down into, race and sex and all the demographics, but just on a state by state, it was a tidal wave, and these are the reasons why. And you still have the Dems out there pounding the table, making excuses and trying to, move in the opposite direction. They're kind of, they're like Biden behind a coconut tree now, just talking to themselves. Like no one cares. You're just embarrassing yourself. So just kind of, keep it moving. And that's kind of where we're at as far as I'm concerned. If we bring this over and we dip into the equity markets, I saw something that was pretty interesting, because now you have this situation where the consumer is strapped. Day to day is tough for most of America. And it's tighter for all of America. But for most of America, it's difficult. We know it's difficult. But we have this equity market, this risk appetite it just seems like it's just insatiable. And it really has been a phenomenal year for the S&P, up 27% on the year. Now, I would say that breadth there really quick as you look at the FANG stocks are up something like 60% for the year. And they're accounting for about 45% of the move in the S&P. So you have about 7 stocks moving half of the entire S&P 500. So that's not a great thing, but I'm not going to go down that rabbit hole. We have a record high households with exposure to the market. It's something like 54% of all households have equity market exposure, stock market exposure. We've talked in the past few weeks months about how the margin accounts for institutional investors, those margin payments and interest payments to the prime brokers at all-time highs. Well, that means that those institutional investors are levered up, taking loans against the collateral in their account, paying interest on that loan to the broker, but then using that money to go and buy more commodities, buy more equities, buy whatever they're gaining exposure to. They're gaining market exposure long on balance. We have all-time high exposure in the futures market as far as equity index futures. Like we are over-levered, overexposed. When you start to look at retail, a lot of times people will say the retail investor is the quote-unquote dumb money, so they're the last ones in. So as the institutional investors have invested and market has rallied, and by the way, some of the largest, most savvy institutional investors and hedge funds now, and I'll name Co2 and Point72 as two, are net sellers of tech right now as a point. And as a second point, we already talked about Warren Buffett being 50% cash in his investments. I don't care if he's getting ready to move on and there's a transition period coming. I don't care if they're getting ready to buy a private company or take a company private that's public. 50% cash for Berkshire clearly means that valuations are not where they want them to be. And net sellers of technology in the hedge fund space, another red flag. And by the way, insider selling, C-suite selling of common stock is actually at an all-time high as well. We shift back, because I went down 5 rabbit holes there and I apologize. We shift back to a great indicator of what the retail investor is doing. So, EJ, you know these leveraged products. So it's like the 2 times bull. You can buy the SPY and it'll track the SPX 1-to-1, or you can buy the 2 times bull, the 3 times bull. And within that product, you're actually paying for leverage up. So if the S&P, if you buy that 2 times bull and the SPY or the S&P goes up 1% on a day, on that given day, you'll make 2% on your money. However, if it goes down 1%, you'll lose 2% on your money. So you're playing a levered game long and short. The chart we have to show is actually we are at an all-time peak as far as where the levered money is on the retail side. So in early 2022, we were up at the current peak now as far as long to short leverage. So the individual investor, the retail investor, is now about 13 or 14 to 1 levered long versus levered short. And that's exactly where we were in January of 22. The chart we have up is 2022 full year. As we hit that 13, 14 level, levered long versus short, so 13 levered long versus 1 short, a 13 to 1 ratio. We're now at a 14 to 1 ratio. 2022, that actually was the peak, and we sold off 27% peak to trough for 2022. Now, I'm not saying that this is it's an exact science, and because that this one indicator, levered bulls are out there, retail money is pushing hard, and now we've hit a prior peak, that we're going to fail and the market's due for a 20 to 30% pullback. I'm not saying that. What I'm saying is that we're at an extreme in a few different areas. There are flashing lights and there are a lot of anecdotal data points to say we are probably at a top or approaching a top or forming a top. This is another one that I thought that was pretty interesting. So retail money in levered products, 13, 14 to 1 long to short, matching the 22 peak, which was followed by a 27% sell-off. Are they late to the game? Maybe they are. Is there more to come with the Trump administration? And are things going to turn around real quickly? Are earnings going to grow faster than expected? Is inflation going to really tone down? Are rates going to really come in? They may. That doesn't look like where we are. And when you see leverage like that in the retail space, it's another reason to take a step back and say, I think we might want to pare down here. I think I might want to just take some off the table and go to cash a little bit more than I am at the moment if I'm fully invested.
This is so interesting, Anthony, because it really parallels something else we've seen with S&P Global. They do their investment manager index each month, and risk appetite absolutely exploded right after Trump's victory. And I mean, the survey data was literally taken right after the week after the election. So it's hard to say there's no relationship there. But the point is just that the explosion in risk appetite, it really does seem like investors are overdoing it, to your point. And the fact that we have that much leverage in the longs versus shorts, that people are so confident that the market's just going to continue going up forever. It's really, it reminds me of Irving Fisher, a professor in 1929, who said that we seem to have reached a permanent plateau, a high plateau for stocks. In other words, they just can never go back down. And then, of course, shortly thereafter, we get the crash in October of 1929. So again, not saying that that's what's going to happen, but when we look at a lot of the things that have been driving stocks, and again, these are things we've talked about before. All the money coming out of the reverse repo facility at the New York Fed, that peaked at $2.5 trillion. And as all of that money has come out, it's basically been lent to the Treasury. And as the Treasury spends that money, it is slowly but surely finding its way, into equities, and it has been fueling a rally. And that facility is down to, I think, 100 or 150 billion dollars now. I mean, that trade has played itself out. I think you can say there's no more room to run there, and it is a question of where is the money going to come from that's going to continue fueling this rally. I don't see it.
Yeah, and I think the incremental buyer, at this point needs a new story. The story right now at the moment has been Trump and year end. And there is a FOMO, and it's not only a FOMO, like it is you have watermarks you need to achieve. You need to be paid. Like a lot of the funds, a lot of the hedge funds, remember the long onlys, the large, the Fishers, the Dreyfus funds, all the large Fidelity, they all closed their books 2 months ago. The hedge funds are now marking to Deck 31. They want to be paid. That's why they're there. They get a management fee, but they get the performance fee is where they make their money. And a lot of their money is reinvested in the fund. So this is a Trump bump. This is a looking forward sentiment thing. And it's also I need to chase this. I need to be a part of this heading into year end. And if I can lever up even and push this thing and be involved and get some extra juice and tack on another 200, 300 basis points netted out by the end of the year between November and December 31st, like let's have at it. That's why I have the money. We're not here to sit on our hands and not make money. We're here to make money. The problem will come to that point is where's the incremental buyer come January? Like is that leverage going to stay in place? Are we still going to be buyers? Or is that leverage going to be, is some of the air going to come out of the balloon, loans paid back, people pared down, and then repositioned for 2025? If that's the case, then I would argue, and I wrote it in my note 2 days ago, right before yesterday's kind of not sell off, but a little 60 bip dip. I don't see higher prices from here for the balance of the year. I think we have the juice in the market that we had. People chased, and then heading into next year, we need to find that buyer. We need to find the reason why we're going to go higher and why money should be invested and where is that money going to come from. I'm not sure that we have it. I'm more apt to think that we could grind, kind of form a top here and see a real retracement down and kind of reset. And that may be, a 5 to 10% move down, depending on how. I like to say it's not if, it's when and how we make that move. But there's some real potential here to see easily a 20 to 30% drawdown in the markets. Now, momentum right now, based on everything we've just said, as expected, is bullish. If you look at the daily momentum, there's some more volatility there, but typically bullish. It is basically bullish. It's kind of flat to bullish now. My signal is in a neutral now. I actually came out 2 days ago of the long, and I am neutral, so I am essentially flat. Net short in some of the futures trades, but essentially flat in equities. But if you look at weekly, monthly, longer term momentum, there is definitely a bullish trend there, and we remain bullish. But if that starts to break, you're going to see some recognition and some selling, and that could definitely feed on itself. So keeping an eye on that, making sure we're watchful of the policy side, the economic releases. What does inflation look like? What do rates look like? Where does it look like money flow is? And then who's going to step in January, February, March? Or is the first quarter going to kind of be the beginning of or the reset for the markets? I think there's a good shot that we definitely see some retracement to the downside for first quarter of 25. So that's kind of what I'm setting up for.
So, Anthony, in regarding that question you raised of the how and the when, what are you thinking in terms of like all the bad news we keep getting out of commercial real estate? The bad news we're getting in terms of the consumer essentially relying almost exclusively on debt to continue fueling this spending binge. All of these things are cases where we're basically just waiting for the music to stop, and then we're gonna end up seeing who's without a chair, right? Yeah. And in the case of commercial real estate, again, these are things we've talked about before. You have to worry not only about the people, the investors holding that commercial real estate debt, but also the regional banks, the small banks who basically hold almost all of the commercial real estate on their balance sheets. So now it becomes not only a real estate issue, but a banking issue. And obviously there's fallout that will stem from that. You and I have actually written multiple times on what a ticking time bomb commercial real estate is, how at this point, the underlying assets have really already fallen in value. We're just waiting for the derivatives market to catch up. I mean, it feels like any of those different things could be the catalyst that really cause that retracement you're talking about. Is that fair?
It's totally fair. And there's an old saying that the market can stay illogical longer than you can stay liquid. And this is the point, right? We're going to work through a process where all of these data points get digested. And at the end of the day, and I do believe this, the headline is totally interchangeable. We could have a headline that kicks off selling and kicks off an explosion of a chain event or chain reaction of selling, of fear, of a spike in volatility, all the things. And they'll look back and go, yeah, it was that headline about the real estate investments in Chicago. And you're like, no, it wasn't. It was the 20 previous headlines, data points, reports, and earnings reports that showed there was a ticking time bomb and that the ground was not safe. But no one's paying attention to it because it's this process, right? It's not like you can just hit a button and pull. You have to be invested. You have to be playing the game. And at the end of the day, that's really what it comes down to. You cannot miss out on market moves higher, and you cannot miss out on earnings and growth and just performance. So these are all real concerns, but in your mind, you need to, and it's hard to sometimes, and I find myself challenged to separate what policy is, what the numbers really look like. And speaking to you and in reading your work, like I know that there are massive underlying issues in the economy, whether it be inflation, whether it be the consumer, so on. But for those things to work their way into execution of investments, it takes time. And it's not even that the larger and the smart money doesn't see it. Of course they see it, but they need to be tactful in how they close that spread between their view, their longer term view, and what they're executing, right? There's a difference between theory, between policy, between what they see out 1 quarter, 2 quarter, 3 quarters, and what they see happening right now. So yes, it's going to take some time for all of that to resolve and kind of collide. And that will become the selling event, the recognition event. And then we'll enter the fear phase where everyone's afraid of losing the profits that they've just chased for 1 year, 2 years, 3 years, 5 years. I mean, honestly, the market's been on a tear forever. So we looked at that last week. We're up 800% since we broke out of the consolidation coming out of 03. Then that fear phase is going to be it can be very nasty. And that's how the how comes in. How are we selling off? How are we tracing? Is it orderly? Are we finding support? Are we starting to find buyers on the dips? Is the story changing as we move down? Does the government step in, wipe out the issue, right? SVB is a great example of a real move down, a real scare, but it kind of got squashed quickly. It kind of, everybody ran, put their arms around it, moved it to the side, and then we kept it moving. And then we became, AI. And if you notice, that was the beginning of, on the investment side and the performance side of equities, that's when AI became the thing. We needed a new shiny ball. When we run out of shiny balls and everyone's like, okay, we're good, we're colliding and we're done, everything's coming to light, and it was this headline that did it. Okay, it's that headline that did it, but the conversations we're having now are the ideas of being safe, being cautious, watching it develop. Because like I say, the market tops are generally processes. They take months, quarters, sometimes years to develop. Market bottoms happen pretty sharply, right? So the average bull, just as an example to end it and wrap it up, the average bull should run full cycle about 10 years, say. But the average bear market is going to run about 6 to 8 months. Right. So you will find, and you will end a lot of times on a capitulatory sell-off, whether it's a 1-day V bottom or a weekly V bottom. You end up with, because that's an emotional state of puking. You just want out. The bull market, you don't want to give up those gains. You don't want to give up the feel good story. You don't want to give up your positions. You've worked hard to have them. You've chased them. You've levered up. You've done all these things. And that's where you're going to make your money. So when the underlying whether it be commercial real estate, whether it be inflation reigniting, whether it be what real rates really are, whether it be consumer debt, when those worlds collide with execution on the equity market side, and I mean execution by guys hitting the button and selling, or by stop the buying and delever, that's when we'll start to see things kind of come unraveled, and it will be a process. But at the end of the day, we'll look back and be like, oh, we should have seen probably those 20 clues, but nobody talked about them until we were 3/4 of the way down to the lows. And that's just the way it always is. It was the same in 2008, 2000. We started to see issues with real estate coming out of 2005 into 6 and 7, right? And we didn't bottom until March of 2009 in a disgusting capitulation at which essentially was 666 on the S&P, but we'll call it 667 just for, good luck. That's how these things roll, and they never change, because at the end of the day, it's all emotion. The inputs are different, the data points are different, but it is all emotion, and human emotion doesn't change.
Yeah, and kind of tying that point in with something you said earlier about the retail investor versus the big money, how they seem to be at different points in this cycle. One of the, going back to 1929, one of the Morgan partners, he decided to sell all of his stock basically at the peak in September, about a month before the crash, and the reason was because he heard his barber basically saying what a great investment stocks were, and at the same time his shoe shine boy had started calling himself a financier because he was making so much money in the market. And at that point, the Morgan partner said, "This sounds like a bubble," and pulled all his investments and just went to cash. And a month later, that was certainly justified.
It's a real thing. It's also a real thing that the bond market will lead the equity market. So the clues, the beginning of the clues, and we talked about that Minsky moment last week. You watch the bond market. The bond market will typically be a leading indicator of the equity market. So all great points. But I'll end with the fact that my 18-year-old hit me about a month ago and wanted to know if he can open up an E-Trade or cryptocurrency trading account, because he felt like there was a way to really make a lot of money. So,
all right, that's it. I'm all in cash. That's
I'm out.
I'm done. I'm done tapping out, boys.
EJ, take it easy, my friend. Always a pleasure. Good luck with everything, and I will talk to you next week.
Till then, Anthony.
Thank you, sir.